Let's talk about a stock that's down over 25% in the last month. Its ticker is OPRA, and its name is OPRA. You might remember it as that web browser from the 90s. Most investors have written it off, calling it boring and outdated. But what if I told you this boring company just raised its dividend, is growing revenue by 23%, and is rolling out AI features to 80 million users? And top analysts think its stock could be massively undervalued, with one model suggesting it's worth 68% more than its current price. That's not a boring story. That's a potential opportunity hidden in plain sight. Welcome to Invest Easy 101. Today, we're doing a deep dive on OPRA Limited. We'll break down why its stock is down, what its AI strategy really is, and whether this is a classic value trap or a smart bet for 2026. Most importantly, I'll teach you the simple checklist I use to spot these kinds of situations myself. So, what is OPRA? It's a software company best known for its web browsers. Think of it like a smaller, nimbler alternative to Google Chrome or Apple Safari. For years, it's been popular in Europe and emerging markets for being fast and packed with free features like a VPN. But here's the secret they don't want you to miss. OPRA is no longer just a browser company. They're rebranding as an agentic AI company. Now, ignore the jargon. What that means is they're baking AI right into your browser to help you search, write, and get things done faster. It's like if your car company suddenly announced it was putting a rocket engine in next year's sedan. The outside looks familiar, but what's under the hood is completely new. That's the shift happening at OPRA right now. This AI push isn't just talk. In late 2025, they launched new AI features across all their browsers. They're giving over 80 million people free access to advanced AI tools. Why? To get them hooked. The goal is to become your AI-powered sidekick for everything you do online. And it's working. They're adding users fast. In Europe alone, their daily users on iPhones have nearly tripled in 2 years. Imagine a local coffee shop that quietly triples its customer base. You'd want to know why, right? For OPRA, the why is AI features and a solid product. More users today could mean much more revenue tomorrow. But a growing business doesn't always mean a rising stock price. In fact, OPRA's stock has been on a roller coaster, falling sharply recently. This disconnect is what makes savvy investors start paying very close attention. Let's address the elephant in the room. If the business is doing well, why is the stock down? In the past month, OPRA shares are down about 27%. That's a big drop. For many, this screams trouble, and they hit the sell button. Sometimes a falling stock is a warning sign. Other times, it's a sale. The key is to figure out which one it is. Is the company broken, or are investors just scared and emotional? To answer that, we don't guess. We look at what the company is actually earning and paying out. And here's a huge clue. While the stock was falling, OPRA's board did something very confident. They declared a cash dividend of 40 cents per share. Companies don't hand out cash if they think the wheels are falling off. It's a $36 million vote of confidence in their own financial stability. This is where our analysis begins. I use a simple 4-question checklist. Question 1 is the most important. Is the core business healthy and growing? For OPRA, the answer from their last report is a clear yes. Their revenue grew 23% year over year to $152 million. They even raised their profit expectations for the full year. Let's simplify that. Imagine your favorite pizza place. Last year, they sold $100 worth of pizza every day. This year, they're selling $123 worth. That's solid, healthy growth. They're also forecast to keep growing. Analysts, on average, see their revenue climbing another 21% in the next year. So the engine of the business is still running strong, even if the stock's windshield is covered in pessimism.
Question 2. Is the stock cheap or expensive? We look at the price to earnings, or PE ratio. OPRA's PE is around 16.7. Now, the average PE for other software companies is about 35. That's like our pizza place being valued at half the price of the pizzeria next door, even though they're growing just as fast. One detailed analysis even suggested OPRA's true fair PE should be closer to 29. If that's correct, the stock could be trading at a significant discount. This is what value investors look for. Question 3. What's the future story? We already covered it. AI. They're not just adding a chatbot. They're weaving AI into the fabric of the browsing experience for millions. If this experiment works, it could change what people think OPRA is worth. Question 4. What do the experts say? Analyst opinions are mixed, which is common for controversial stocks. Some see big potential. TipRanks notes one analyst has a buy rating with a $27 price target. That's nearly double where the stock trades today. Other models are even more bullish, suggesting a 68% upside. But we must end our checklist with the most critical part, the reality check. What are the risks? First, competition. They're up against tech titans like Google or Alphabet with near unlimited budgets. Winning in AI is an expensive arms race. Second, execution. Can they actually turn cool AI features into sustained profit? It's a huge challenge. Third, sentiment. The stock is small and volatile. Fear can keep the price down for a long time, even if the business improves. Now, here's what makes OPRA uniquely interesting for 2026. While we wait to see if the AI story plays out, the company pays us to wait. That 40 cents per share dividend translates to a dividend yield of over 2.8%. Think of it like renting out a room in a house you're renovating. The rental income, the dividend, helps cover your costs while you work on increasing the house's overall value, the stock price. It's a safety net that most hypergrowth AI stocks simply don't offer. This combination is rare. You have a company investing heavily in a high-growth trend, AI, but you also have it generating enough cash to share some directly with shareholders. It balances future potential with present-day reward. So, what's the final verdict for a beginner in 2026? OPRA is a fascinating case study. It is not a sure thing. It's a higher risk, higher potential reward idea compared to the giant ETFs we usually discuss. Our checklist shows healthy growing business, check. Stock looks cheap, check. Compelling future story, check. Some expert backing, check. Clear risks, double check. It passes the initial smell test for a deeper look, which is all we can do as researchers. For 2026, the outlook hinges on one thing: proving the AI bet. If they can show that their AI features lead to even faster user and profit growth, the stock could re-rate dramatically. If they stumble, it could remain in the boring bin. The dividend provides a cushion, but the big gains depend on executing the vision. Remember, I'm not telling you to buy OPRA. I'm showing you how to analyze a stock that the market might be overlooking. Your homework is to take this 4-question checklist and apply it to another company. It's your new investing superpower. If you were to invest, think of OPRA not as the foundation of your portfolio, but as a potential enhancer. Your foundation is still those broad, low-cost index funds like VTI and VOO we've talked about. A smaller position in a stock like this is about seeking growth on top of that solid base. The goal is to build a portfolio that's both stable and has exciting growth potential. That's how you build long-term wealth. If you enjoyed this deep dive and want more videos where we analyze specific stocks with this clear, beginner-friendly framework, please subscribe and hit the bell icon. It helps more than you know. Now, I'd love to hear from you. Did this change your view of OPRA? What other boring companies should we put through this checklist? Let me know in the comments below. Thanks for watching, and I'll see you in the next video.